I think the economy's doing fine. There are things that are getting added to the equation, in particular the trade war with China, that is having an impact. It's having an impact on growth. When you put trade policies into place, they do have an impact, on the economy, and we have to live with that impact. I think the chance of a recession in the near term is still relatively low, but we have to watch what's going on with tariffs. We have to watch the U.S.-China relationship. We have to watch some of the other geopolitical noise that's going on, and confidence can, have an impact on growth.
That's the CEO of Goldman Sachs giving his assessment on the economy and where we could be headed as we head into an election year. Many other top economists are a lot more bearish. Bank of America is one of them. Its global economist says there's a 1 in 3 chance of a recession just next year. Here to discuss, Chief Economist at the Coalition for a Prosperous America, Jeff Ferry. Jeff, President Trump keeps touting the strength of the economy, but we're increasingly seeing signs of turbulence. Is the economy as strong as the president claims, and what would you put the odds of a recession on or a significant downturn between now and, I'll pick a date at random, November 2020?
That's a year and a half out, Andrew. So I think the economy is pretty strong. We're seeing growth of 2%, between 2 and 3%, which is pretty good. We're in year 10 of a recovery. So you've got to remember this recovery has gone on for a long time. I do agree with those pundits and economists who are saying we could have a recession in the next 18 months. I mean, I would put the odds at about 20%, let's say. We've seen signs of weakness in certain markets. Auto sales are not great in this country. Certainly Europe, the European economy is looking weak. Germany's export machine is looking weak. Once again, Southern Europe, Italy, not looking good. There's problems in Asia. So, we've got these problems. We've basically got interest rates so low that they indicate there is not enough demand for investment funds. I'd like to see a stronger U.S. economic recovery. But, like I say, in year 10, things are humming along pretty well. As you know, unemployment's down to 3.5%. So things are moving in the right direction.
I want to drill down on some of the points that you just made, but I want to start with China. And Goldman Sachs, which is still the gold standard on Wall Street, is out with a new forecast, cutting its growth projections for the nation's economy and bracing for full tariffs on China, as well as some fears of a recession. They also mentioned that there's an impression among companies that they're going to go slow on hiring and spending, in part because of China and because of fears of a recession. So what's the fear with China and these latest tariffs? That the direct impact those tariffs would have on the economy, or that this undoes the chance for a wider trade deal and so overall things get worse?
Well, we at the coalition have always been pessimistic about the possibility of a trade deal. We think what President Trump is asking for are the right things to do. China's been running its economy in the wrong way for 2-3 decades now, and we simply have to put a stop to intellectual property theft, to unfair trading practices, to government subsidy of so many industries, because they are causing us a lot of industrial pain here at home. So those are the right things to do. Myself, I don't think China can accept a trade deal because their entire totalitarian communist system is based on some of those things. So I think we're heading towards decoupling, meaning the U.S. economy is less involved with the Chinese economy and vice versa. We've already seen that means slower growth for China. Now, what does it mean for us? As we just said, the recovery is trucking along okay over here. I do think we're going to see, we already are seeing manufacturing companies leaving China en masse, and a small but growing number of them are coming back to the United States. So there is a cost in terms of adjusting to the new normal, which is supply chains that are more localized, supply chains moving out of China into Southeast Asia, into Mexico, into the United States. Now, does that hit some corporate profits in the short term? Yes, I could believe it does. I could see Apple could have trouble selling iPhones in China in the short term. But you've got to remember, China's long-term plan for smartphones was for Huawei and Xiaomi to replace Apple in any case. So, you can't mix up these two things. There's a long-term structural change we need to make to correct a situation where we've run trade deficits for 43 years, and that's weakened our industrial base and weakened real wages for workers. On the other hand, are there short-term adjustment costs? Yes, there are, and that might hit some corporate profits this year. Finally, last point I'll say, look, Goldman Sachs, they put Gary Cohn into the administration in 2017, and he's the Goldman Sachs VP who resigned and fought really hard against Donald Trump over this trade policy. And I think Goldman Sachs have got a bit of a vendetta here. They're looking for things to go wrong. They published a study showing there's inflation due to the tariffs. I think if you look at the consumer price index, it's pretty clear that the most interesting revelation about tariffs in the last 2 years has been you can levy tariffs on 6,000 lines of Chinese products and 4 major sectors, steel, aluminum, washing machines, and solar panels, and see zero change in the consumer price index. That's a very interesting development and tells us that a more intelligent strategic trade policy can help the United States with minimal impact on inflation.
We know that China just downgraded their currency and were then labeled as a currency manipulator by the Trump administration, which the president has been calling them for 30 years, but apparently they hadn't been doing in some time. We know about concerns about the Chinese economy, but was this currency move just a response to Trump, or is it your sense that it was based on China's real economic needs?
Well, I think, again, it's hard to separate those things. The currency move of the renminbi in the last week or 10 days is a response to President Trump's statements about when it doesn't look like we're heading towards talks. Instead, we're going to have more tariffs. But these tariffs over the past year have weakened the Chinese economy. Some people are saying this 6.2% growth number is not only the worst for China in 15, 20 years, but it's also somewhat artificial, and the Chinese economy is doing worse than that. Now, that's partly due to tariffs, and it's partly due to other structural forces within the Chinese economy. But look, they manage their currency. They manage it 365 days a year. The fact that they're not actively manipulating it now and for the last couple of years doesn't mean that anytime they want to step into the marketplace and manipulate it downwards, as they did last week, they will do that. And in fact, the last thing I'll add is many countries do that. The U.S. is at a disadvantage because we don't manage our currency, and our currency is, in fact, our own estimations are 27% overvalued.
Finally, I want to get to that Fed interest rate cut. A lot of people were questioning whether it was needed or just capitulating to the demands of the president. Did the Fed make the right move, and how dangerous is that cut if we hit a recession and we need the Fed to step in and help with the recovery?
Yeah, I mean, I think the world as a whole is suffering from a global overflow of savings. We have far too much savings in the world. We also have far too much labor and far too oversupply of many resources, and that has depressed interest rates. I think it was right to cut interest rates further, given that the economy is weakening now in the second half of 2019. You see interest rate cuts in India and other countries as well. So this is a problem many governments and central banks are dealing with. I mean, you're absolutely right that there could be dangers down the road if the economy gets worse, and then the Fed's got to dig deeper into its bag of tricks to find out what the next trick is. And, of course, we've been here before. We had quantitative easing in the past and Operation Twist. I mean, I have some confidence that the Fed is resourceful to find solutions when necessary. I also think that they're not capitulating to President Trump. I mean, President Trump's got a message. He wants them to help the economy because it's weakening. And I think they're reaching that judgment independently as well.
Jeff Ferry is the chief economist for the Coalition for a Prosperous America. Jeff, appreciate a few minutes. Thanks.
Thank you for the time. Thank you.
And up next, a water warning in Newark, a battle over a major cross street in Manhattan, and major changes coming to the T in Boston. All that and more in our Corridor Report right after this.